Picking your very first stock can feel, well, totally overwhelming, right? It's like you're lost in this massive jungle of financial jargon, hot tips from your cousin, and 1,000 different opinions. But what if you had a clear, simple framework to follow every single time? Well, that's exactly what we're going to build here, step by step, so you can make that first investment decision with real confidence, not just hope.
And this right here, this is the whole game. This sentence is the bedrock of everything we're about to talk about. See, successful investing isn't about some mystical gut feeling or getting lucky on a meme stock. That's not investing, that's guessing. Real investing is a skill, and it's built on a repeatable process with super clear rules. This framework is going to make sure you know exactly why you're buying something, and, just as important, when it's time to get out.
So here's our roadmap for today. We're going to start with getting our mindset right, the difference between investing and guessing. Then we'll dive deep into our 4 pillars of investing. That means figuring out what to buy, knowing when to buy, and then building your own personal playbook to manage everything. And to wrap it all up, we'll give you a simple workflow to get you started. Sound good? Let's go.
Okay, first things first. Before we even look at a single stock or a single chart, we have to start right here with a huge mindset shift. This is all about leaving behind the habits of a gambler and starting to think and act like a real disciplined investor.
Just look at the difference here. On the left, you've got the gambler. They're living in chaos, right? They're emotional, they're reacting to every news alert, they're terrified of missing out. It's all based on hope. But the investor on the right, they're calm, they're analytical, they've got a checklist, a plan, and most importantly, they're focused on managing risk. This is the shift we're making today, from the left side to the right side.
So that brings us to our very first pillar, fundamental analysis. Now, I want you to think of this part as being a detective. This is where we put on our trench coat and investigate a company to figure out what it's actually worth, completely separate from its stock price for the day. We are looking for real substance here, not just social media hype.
In this famous quote from Warren Buffett, it is the absolute heart of value investing. Price is just that flashing number blinking on your screen. It changes every second. But value? Value is what the business is truly worth. You know, its health, its profits, its future. Our whole goal as investors is to find fantastic companies where that true value is way higher than the price tag you see today.
So how do we find that value? Well, a great place to start is with Warren Buffett's 4 non-negotiables. Before he even considers putting $1 into a company, it has to pass all 4 of these tests. First, is it run by smart, honest people? Second, does it actually have a future? Is it selling something the world will need in 10 years? Third, is the business stable and simple enough that you can actually explain how it makes money? And finally, only after all that, is it selling for less than it's worth?
Okay, so how do we figure out if a stock is undervalued? A fantastic tool to start with is the PE ratio, or price-to-earnings ratio. Sounds complicated, but it's really not. It's just a price tag. It tells you how many dollars you have to pay for just $1 of the company's profit. So for example, if a stock is $100 a share and the company makes $5 in profit per share that year, its PE ratio is 20. You're paying $20 for every $1 of earnings. Generally, a lower PE can be a sign that you're getting a better bargain.
Let's make this super practical. Look at 2 different companies here. You've got a growth powerhouse like Apple. It pumps its profits back into the business to create the next big thing, so investors are willing to pay a higher PE for that future growth. Then you have a super stable company like Procter & Gamble. It's more focused on just returning profits to you, the shareholder, through dividends. Now, there's no better stock here. It's about what you want. Fundamental analysis helps you see which one actually fits your goals.
All right, so once we've found a company that we think is a great value, we move on to pillar number 2, technical analysis. This is all about answering that big question, okay, so when is the right time to buy? And let me be perfectly clear. This is not about using a crystal ball to predict the future. It's about reading the story of supply and demand, the psychology of the market that's being drawn for us on a chart. The absolute most basic thing we want to see is the trend. An uptrend, like you see here, is just a simple pattern where each peak is higher than the last one, and each little valley is higher than the last valley. This is a visual sign of pure optimism. It shows us that the buyers are in charge and are willing to pay more and more for the stock over time. You've probably heard the saying, the trend is your friend. This is what they mean.
And on the flip side, you have a downtrend. It's a pattern of lower peaks and lower valleys. This is a clear sign of pessimism. The sellers are in control, and the market keeps valuing the stock at a lower and lower price. As a beginner, trying to buy a stock that's in a clear downtrend Well, it's like trying to swim up a waterfall. It's not a great idea.
And then there's this, a sideways market. The price is just kind of bouncing around between a floor and a ceiling. This is a sign of pure indecision. It's a tug of war between the buyers and the sellers, and nobody's winning. I like to think of it like a coiled spring. These periods often happen right before a big, powerful move, once one side finally gives up.
So we get the overall trend, the big picture. But what about all those little individual red and green bars on the chart? They're called candles. What are they actually telling us? How do we even begin to read them?
Okay, stay with me on this one, because it's a fun and really helpful way to think about it. Think of each one of those candles as a short little episode of a sitcom, like Seinfeld. Each episode, whether it's a day, a week, or even just an hour, tells you the story of what happened between the buyers and the sellers. It shows you 4 key plot points: where the price opened, the highest it went, the lowest it dropped, and where it finally closed. That's it. It's just a mini story about that slice of time.
All right, so Pillar 1 helps us find what to buy, and Pillar 2 helps us find when to buy. But these next two, Pillars 3 and 4, these are the ones that are going to keep you in the game for the long haul. This is all about building your personal playbook, connecting your investments to your real life, and most importantly, protecting your hard-earned money.
Pillar 3 is all about cash flow, and it brings everything back to you and your goals. Ask yourself, why are you investing in the first place? Are you trying to grow a nest egg for retirement in 30 years? Then you're probably looking for growth stocks. Or are you trying to generate a little extra income right now, today? Then you're looking for stable companies that pay out dividends. A stock is only the best stock if it's the best one for your specific plan. And now we come to the cornerstone, the most important pillar of them all: risk management. Look, anybody can get lucky and pick a winner once in a while. But the true skill of an investor isn't in celebrating the wins, it's in managing the losses. Your ability to survive and thrive in the market over the long term depends almost entirely on how well you protect your money when you're wrong.
A super simple way to do this is with the TEST framework. Before you ever hit that buy button, you define these 4 things: your target, a realistic price to take profits; your entry, the exact price where you'll buy; your stop, and this is everything, the price where you admit you were wrong and you get out to stop the bleeding. Think of it this way: you would never get on the Titanic if you knew it had no lifeboats. Your stop loss is your lifeboat. And finally, time. A general time frame for how long you expect this all to play out.
And this is exactly why that planning is so critical. Let me ask you this question. Would you ever, in your right mind, risk $460 for the chance to make just $40? Of course not. It's a horrible bet. But without a plan, investors make trades with that exact kind of terrible risk every single day. Defining your target and your stop before you buy forces you to actually look at the risk versus the reward and make a smart, calculated decision.
So, we have our 4 pillars. We've got the theory down. Now, how do we actually put it all together into a practical workflow you can use, like today? Let's build the action plan. Okay, your absolute first step, and please do not skip this, is to open a paper trading account. Think of it as a flight simulator for the stock market. You get to use fake money to trade in the real market. It lets you test this entire framework, make mistakes, and build confidence without risking a single penny of your real money. Seriously, for any new investor, this is non-negotiable.
Now, for finding a stock. With thousands and thousands of them out there, where do you even start? You use what's called a top-down approach. It's like a funnel. First, you look at the whole market, like the S&P 500. Is the overall tide rising? Then you look at which sectors, like tech or healthcare, are the strongest. Inside those sectors, you find the leading industries. And only then do you zoom in on the best individual companies. This filters the whole universe down to just a handful of great candidates.
And the best tool for this job is a stock screener. You can find free ones on sites like FinViz or Yahoo Finance. A screener is basically a search engine for stocks. You can just plug in your criteria from Pillar 1, things like, show me all companies with a PE ratio under 20, or a price above $10, and boom, it spits out a list for you. It's how you can apply your rules to the entire market in seconds.
We have covered a ton of ground here, but you now have a complete framework. You've got the mindset, you've got the 4 pillars, and you've got a practical workflow to find and manage your first investment. The theory part is officially over. Now, the real journey of practice can begin. And as you start that journey, I want you to burn this quote into your brain. Your opinion that a stock should go up is completely worthless. The market, what's actually happening on the chart, is the only truth. A good investor respects what the market is doing, not what they hope it will do. Trust your system, trust your criteria, not your ego.
So, we'll end on this question. You have the full roadmap now, from the right mindset all the way to a practical plan. The only thing left to do is to take that very first, small, risk-free step. So the question is, what's it going to be? I really hope you'll consider opening up that paper trading account and start building your skills as an investor today. Thanks so much for tuning in.